We've got 30 June approaching. What I would say to all our viewers, do not leave it till June 30 to do anything.
What do I need to do, and can superannuation help me reduce my tax bill?
Superannuation is deliberately by the government a tax-effective vehicle to save for your retirement.
Hello and welcome to Super Insider, a podcast on superannuation, retirement, investing, the economy and even tax. Today we will be talking strategic planning, short-term and long-term as it relates to tax. And the marvellous thing superannuation is in potentially, notice I said potentially, paying less tax. My name is Anne Fuchs, and with me on the sofa is Kane Everingham, one of the leaders of our most amazing, I would say best-in-class education team here at Australian Retirement Trust.
Thank you for having me, Anne. I'm glad to be here.
Now, listeners and viewers, we are going to be talking about tax today, and I can hear in my head a song from Salt and Pepper. Let's talk about tax, baby. But, yes, I just did it. I'm sorry, Kane. But listeners and viewers, you know that this is general information, general advice only, and we implore you to please get some professional advice, whether it's from your accountant, financial advisor, call us. Please do not act on anything that you hear Kane and I talking about today without some professional advice for your circumstances.
Definitely.
Okay, so we are going to talk about how you can save tax, and in my head, two types of members, and I'm going to use names that could be male or female: Last Minute Lou,
okay,
and Planned Peter.
All right, I like it. Yep.
Yeah, work with me.
Right.
So Last Minute Lou is like, oh my goodness, what time of the year is it? I don't want a tax bill. My accountant's just told me I need to book in my appointment. What do I need to do, and can superannuation help me reduce my tax bill? Last Minute Lou, we're here to help you.
Yes.
Okay, so let's talk about this member and the different type of circumstances where you could be last minute, tactical, opportunistic, before end of financial year.
So look, that's very common. So all the last minute Lou's out there.
No offence, Lou's.
No offence to any Lou's out there.
Name.
It is very normal, and most people don't realise it till they do their tax return and then see the outcome and like, I should have done something earlier.
Homer Simpson, yeah.
Yeah, so now is a good time. Obviously, we've got 30 June approaching. What I would say to all our viewers, do not leave it till June 30 to do anything. The earlier you can do something, the better. And when it comes to superannuation, the big caveat I'd say is just make sure it fits in with your long-term plan. Because if I put money into super, yes, and we'll talk about there is some tax-effective ways to do that, but just be aware, superannuation is my retirement money, it is preserved, so it's got to match my overall strategy, not just chasing
Don't just dump it in there for the sake of it to save some taxes.
That's
what you're
right,
saying.
exactly.
Okay. But if it was aligned with your desire to grow your retirement savings because you've got a certain age you want to retire by, or you want more money to spend in retirement, and superannuation is so profoundly tax-effective, what would be some last-minute Lou strategies, and what would your circumstances be?
Probably the best way to go for a last-minute Lou is if I've got some money sitting around. So I've got some money saved in the bank account and I know I want to save for my retirement. Superannuation is deliberately by the government a tax-effective vehicle to save for your retirement. So if I put money into superannuation, it's invested, investment earnings are only taxed at 15%. If I've got that money sitting outside super, it's potentially going to be taxed at whatever my marginal tax rate is, which is usually higher than 15%. So if I've got some money sitting in there, I might want to put that money into super before June 30. And I'd say, again, do not leave it till June 30 because you need that money to be in your account before June 30. And I could put that money into superannuation and claim it as a tax deduction. So therefore, I'm serving two masters there. I'm boosting my superannuation, my retirement savings, but I'm also potentially reducing my tax by putting it into super, claiming it as a tax deduction. So it goes in as essentially a lump sum salary sacrifice.
Is there any salary bands or thresholds, or just wider kind of thresholds around voluntary contributions that's worthwhile being aware of in that sort of scenario?
Yeah, definitely. So when it comes to putting money into super, it's just not a free-for-all. So there is an annual limit of before tax contributions. So that's any salary sacrifice you do, any employer contributions going in. That's $30,000 a year in the 2025-26 financial year. So I can't go over that. So it's very important to be aware of that. If I'm on a higher salary, then my employer contributions are going to chew up a lot more. Likely
it's or you're closer to that anyway.
Definitely. One thing to take note of though is there is what we call the carry forward rule. So what that means, so the current limit is $30,000 a year. Last year it was the same, it was $30,000. So if last year between my own salary sacrifice and my employer contributions, I'd only put $20,000 in, I've got $10,000 of last year left over. And then I can carry that forward into this current financial year. So I've got my 30 in this year, my 10 from last year I haven't used. That's what the carry forward rule is. Effectively, it's 5 years on a rolling period. So I could be able to maximise that.
And I think that's particularly good just for women who may have had time out of the workforce, interrupted work patterns, and they could particularly take advantage of something like that.
That's a great example. Or we see it when you've got kids, mortgage, you don't have a lot of spare cash, but often when you get older, the kids are moved out.
Stop paying school fees maybe.
School fees, beautiful. So as you get older, you've got more surplus cash than you've ever had. So you might not be able to take advantage of carry forward earlier in your career, but now might be the time. I've got more surplus cash than I've ever had, so I can boost my salary sacrifice into my super.
Okay, so putting a lump sum in, claiming a tax deduction is one thing you could do tactically before 30 June. What about if you're in a partnership? And not in a business sense, but in a love sense.
Yes, love it. Probably the one that jumps out at me there is what's called the spouse contribution. So we commonly see it. You'll have a higher income earning spouse, a lower income earning spouse. If the higher income earning spouse puts $3,000 or more into their spouse's super account as an after-tax contribution, I need to stress that, then they could potentially be entitled to a tax offset of up to 18%, which would be $540 if they put the $3,000 or more into their partner's super account. So the higher income earner then gets a potential tax offset. The lower income earning spouse gets a boost to their superannuation. So it can be, again, a win-win. Yeah.
And is there anything in terms of low income earners, or is that more of a long-term strategy?
So there is a thing called the government co-contribution, and effectively it's designed for low to middle income earners. There is income thresholds. You're looking at about $47,500 as a low threshold. So how it works is for every dollar I put into super after tax, the government will give me 50 cents as well, up to a maximum of $500, providing I earn less than the lower income threshold. Once I earn about $62,500, then I couldn't get any government co-contribution. But it's designed, if I'm under those thresholds, then I could be getting extra money from the government. So if I'm earning less than $47,000, for example, if I put $1,000 into super after tax, I do my tax return, the government has a look at what I did, what I earned, I would then get $500 co-contribution from the government into my super. So a great way to boost my superannuation if I'm in those income bands.
Have we covered all the last minute, Lou? Opportunistic,
Yes.
last minute. Let's channel Peter, who is much more organised than Lou. What would Peter be doing when they're sitting down and looking at their future financial year and tax planning and making the most out of this marvellous thing called superannuation and the tax effective way it invests money?
Beautiful. Well, for all the Peters out there, generally what you'd be doing is, rather than waiting for the end of financial year and hoping that you've got some money saved up to put into super and claim a tax deduction, you can set it up through your payroll quite often and regularly do salary sacrifice through your pay. So that way it's almost like a set and forget. You have a look at the limits. What's my employer putting in? What's my budget like? What do I want to put into super for retirement? Really, if I'm earning over $45,000 a year, I'm up in that 30% tax bracket or higher. When I salary sacrifice into super, I don't pay marginal tax on that money. I only pay 15% tax. So if I'm earning over $45,000 a year, Pete is probably looking at salary sacrificing regularly out of their pay. Might get a pay rise, so hey, that's some extra money that I might want to plan to put into superannuation as well. So if you're organised, it's more setting it up, planning for across the year. What am I going to do? What am I going to earn? And that's not to say you don't review it, but it's a great way to kick off the new financial year.
So there's salary sacrifice.
Yep.
I think the low-income superannuation tax offset, it's not a tax planning strategy, but very tax-effective way just to call out for people to have their money working for them. Thank you, federal government, for that.
That's it. And that's something that automatically happens. So if you ever hear the term LISTO, that's just the low-income super tax offset. So effectively, if I'm earning under $37,000 a year, my employer's still putting money into super for me, and those contributions are taxed at up to 15%. So this LISTO, what it does is it's effectively a rebate of up to $500 that can come back.
Okay, so salary sacrifice, low-income superannuation tax offset. So spouse contribution, you could do that as well if you're a planned Peter?
Yes, definitely. So, and you'll often find couples will do that, yes, because I'm chasing the tax offset, but often what we find is couples will play that game around, I want to equalise super balances, or if I've got age differences. someone will hit settling age earlier or access super earlier, so couples will play that game of topping up super.
And we have plenty of small business owners. And what about sale of business and sort of those other kind of contributions? Like all of a sudden you've sold your professional services firm or your hairdressing salon and you've got a couple of $100,000 sitting in the bank and you're thinking about whether to tip it into your super. What are the tax considerations there?
As an ex-financial advisor, I'd be talking...
Who's not giving financial advice?
I'm not giving you financial advice, but I'd always be telling that person, well, let's look at what your long-term goals, your plans.
So it's such a big chunk of money.
Yeah. So if the plan is for that, hey, I want that to go towards my retirement, then there is what they call the after-tax contributions into super, and that is the annual limit for that at the moment in the 25-26 years, $120,000 a year. And I can do up to 3 years of that combined in what they call a bring forward rule. So we do see some people take advantage of that because, again, superannuation is such a tax-effective environment to put your savings. Again, being conscious of I can't just put it in 1 week and then go and get it the next week generally. So, but it is a very tax-effective way to save for your retirement. So that could be something to think about for someone in that situation.
Okay, so final words of wisdom, Kane. You talked to hundreds of thousands of members over many, many years. How long have you been with us?
Oh, I think I'm going on 13 years now. Yeah,
old timer. Words of wisdom to Lou. What would you say to Lou?
To Lou, I would say check how much you've put into super this financial year, which you can do through the MyGov site, or if you've only got one super fund, check with your own super fund. If you've got the capacity to put extra money in, then potentially look at that. Do I want to claim a tax deduction on that? That could be something for the last minute lose out there.
Okay, and for Plan Peter?
Look, Plan Peter probably already knows, but I'll be checking for this financial year, make sure I'm on track. I'm not going to breach the cap. Everything's set up beautiful for me. But definitely I've got that eye on 1 July kicking off. I'm having a look. Have I got a pay rise coming in? Have I got my salary sacrifice set up?
So, Kane, I get a refund because I've done my tax planning and superannuation. And rather than impulsively jumping onto a website to buy something that makes me feel good about myself, a dopamine hit, go back to Archives of Super Insider if you want to learn about how to retrain your brain to be far more disciplined about money. So I get my refund. What would I do? What would be some good taxation considerations?
This would probably be where all the Pete's out there would, rather than, to your point, rather than you beauty, I'm hitting the shops, let's blow it. How can I make that money work for me? And that could be, well, I don't have a lot of fat in the budget, but hey, I've just got a tax refund. Do I look to put that into super? So again, depending, the Pete's they'd know what salary they're on, what tax. So it could be, do I put that into super?
And they could check it on the calculator, couldn't they, online, and see what it would become at your retirement age?
There's a great retirement calculator on the Australian Retirement Trust website. You can put your own situation in there and you can actually see the long-term impact of putting contributions into your superannuation.
And the tax refunds as well. As you said, a bit of a small windfall that you may not have, and out of sight, out of mind.
Yeah, and it's that snowball effect. So I'm putting it into super, it's invested. So it's not only growing by the amount of the refund I've put into super, that money's now invested in, it's attracting investment returns and snowballing over time.
Yeah, good. Listeners and viewers, it has been awesome having you on the show today. Kate and I have had a great yarn about tax, and in 2 weeks' time, Josh and Ruth are going to be talking about the roadmap to retirement. I'm thinking I can just see a caravan park going and staying at one of the Discovery Parks that we own. I've just got that visual. They're driving with the topless car. Roadmap to retirement. Here we come. Make sure it's going to be a must listen episode. So tune in.